My goal for this video is to teach you more in the next 30 minutes about trading profitably and professionally than you would see anywhere else. I promise that. And you'll see that there's a link to a workshop, right? But I want you to ignore that for the minute, and I'll explain more about that in a bit if I need to. But right now, I want to help you. So before we dive into what actually works, let's just talk about some of the biggest lies that most traders are sold, especially when they're new, right? Lies that completely wreck their chances of success. And it's really important that you understand these, right? So don't do them. Right, misconception one is trading is easy. You've probably seen it. Trade for 30 minutes a day and you can retire rich by Christmas and sail off into the sunset. Well, the truth is, trading can make you a lot of money. I've made a lot of money, right? But it's not easy money. It's not as easy as people make out anyway. It's a professional skill, and like any skill, like being a pilot or a surgeon or a professional athlete, right? Just like any of those skills, it takes some time and it takes some education and it takes some deliberate practice. So if you go into this expecting fast riches, you're probably guaranteed to fail, because people who chase unrealistic gains and they over leverage, they risk too much too soon, and they crash their account very, very quickly. They blow it up. But if you approach it like a professional, you can build wealth. You can build an account steadily, responsibly, and most importantly, permanently. Right, misconception number two is the more trades you take, the more money you make, right? Another huge mistake, thinking that you have to be in the market all the time. That's not reality. The reality is professional traders, they trade less, not more. They wait and they stalk high quality setups. I'm going to show you in a minute. And they don't chase the market. They let it come to them. More trades just means more randomness, more stress, and more mistakes. So over trading actually leads to random results. And it also leads to mental exhaustion and poor risk management. And really, in the end, it's just consistent losses, which you obviously don't want. And when you go about it like that, you feel like you're working hard, but you're kind of spinning plates with no improvement. Success in trading just comes from a few well-planned, well-managed trades, not constant action. You don't want to be a slave to the charts. And then misconception three is, I just need the perfect, you guessed it, strategy, right? Here's the biggest trap of all. Believing that success depends on finding the perfect strategy, which doesn't exist. Consistently resetting your learning curve, never sticking with one system long enough to actually master it. And what happens is your confidence starts to erode because you think failure is about strategy, when it's really about your mindset and your execution. Imagine trying to learn every martial art at the same time, trying to reach black belt in all of them at the same time. It would take way longer. You probably wouldn't even achieve it. So guess what? Every strategy takes losses sometimes. Pro traders don't win because their system is magic. They win because they execute with discipline. They protect their capital, and most importantly, they stay emotionally in control. So if you're strategy hopping, always looking for the next shiny object, you're not getting closer to success. You're actually starting over and over again, going around in circles. Now, I want to give you a bonus trap that traders fall into, and that is looking at traders online who are telling you that they're getting ridiculous returns. Well, take a look at this. All right, let's take a look at the data here, right? This is a back-tested ton of trades that were taken, 73% strike rate on this particular strategy. And what you'll see traders do is manipulate how much that you can make. And it all looks great until you understand what's going on, right? So it's important you understand this. Let's just look at these charts here, right? So on the left here, we've got a fixed position size. So this is where you're, trading a fixed position size, 1% of your account, and you're doing a fixed position. And on the right-hand side is what we call a smooth ratio money management strategy, which is almost like a trade secret. This is how you really make the money in trading, okay? Because you can have a average strike rate in trading. If you apply a really good money management system to that, like a smooth ratio money management strategy, you can really accelerate your returns. And you can see that based on a $10,000 account, right, trading 2 mini lots, you can see that a fixed money management strategy will increase the equity by 35%. So it's a 35% return. And you got an 87% return on this on the smooth ratio money management. Now, if you look at the chart, it looks very healthy. Bottom left to top right, that's what we want to see. And what we've got here, this is the important part. So this is the delta. This is how aggressively we're going to increase our position size as we're doing well, right? Or as we're taking losses. And what they'll do is they'll show you. So right now you can see this is pretty smooth. All right, we're taking it from 10,000 up to almost 20,000. We got about 1,700 pips closed on this particular test on this performance. And it's great, right? We're taking it to about $18,600 from 10. Now, you can see that we're trading a two mini lot position size, and over the weeks, as we do well, right, you can see that we're going up 2%, down 2%, up 3%, up 4%, and we're increasing ever so slightly on the position size. Got you, right? And that gives us a nice smooth equity curve, which is why it's called smooth ratio money management. Now, if you was to increase the aggression on this system, so let's just say we take this down to 3,000. Watch this number here. It went from 87% to 154%. Now let's get a little bit more aggressive. Let's take it down to 2,000, right? And now all of a sudden we're making 200. We're on our way to tripling our account with the same performance, the same strategy. All right, let's take it down even more. So every time our account fluctuates $1,000, we're aggressively changing the position size. Now look at the units that we're trading now. Look at this. After a few weeks, we're up to 14, 19 mini lots, 11 mini lots, 27 mini lots, right? Now, the most important thing to see here is one, we're now taking an account from 10 grand up to 50 grand, which is much more attractive to attract you to sell the systems, right? Because that's much more sexy. But when you look at the reality in real time, imagine trading that. Look how the weeks go. We can see that we've got 2%. Yeah, that's great. But as we start aggressively changing our position size, we're doing a 9% drawdown in a week. We're doing a 21% drawdown in a week. Now, could you lose 21% of your account in 1 week? I couldn't. That is dangerous territory. And what this does is it starts to introduce emotional challenges which are going to stop you from being able to actually accumulate this performance, right? And that is what they're trying to sell you. And not only that, what they'll do is they'll have two accounts and they'll be trading the same position, but they'll be hedging. And one account they'll be going long, on the second account they'll be going short. And of course, one of them's going to work out, and they'll only show you the winning. They'll only show you the winning account, and that's what they do. That's what these scammers do. So now you understand that, and you've seen that. Let's talk about the truth about trading success and what trading success actually comes down to, because it doesn't come from luck, and it doesn't come from hype, and it doesn't come from secrets. It comes from mastering a few simple principles and then repeating them with absolute discipline over and over again. And that's exactly what I'm going to be showing you right now. Now, firstly, you have to write this down, right? You must have a system with something called a positive expectancy. Write that down. Now, I'm going to talk more on that in a second. It's one of the most important things that you're going to learn. But number two that you want to write down is you must be able to consistently trade the system and repeat it. Got it? So what's a positive expectancy? Well, to work out whether or not your system produces a positive expectancy, because it'd be nice to know if it's profitable before you go out and trade live money, right? Check this out. This is what you need to know. And you won't find this anywhere else with these so-called traders anywhere online talking about this, because this is professional. All right, it's a little bit of math, but don't get too scared. It's 1 plus W divided by L multiplied by P minus 1. Now, what does W stand for? That stands for win. That's our average wins. And then L stands for loss, which is our average loss, right? So let's just say that our average win is $200, right? And our average loss is $170. Now that's pretty tight, but we essentially know that we win more when we're right than we lose when we're wrong. Okay, so let's do the formula with these two numbers. It's really important you understand this. Okay, so 200 divided by 170, right? That's 1.176. Okay, plus the 1, that's 2.176. Whoops. Let's call it 2.18. So when we put that into our formula here, right? So we got 2.18 times P minus 1. Now, what does P stand for? Well, P stands for the percentage of time you are right. So let's just say that you're right 55% of the time. You've got a 55% strike rate, right? So now we have 2.18 times 0.55, which equals 1.2, rounded up. And then you take away the 1 and you got 0.2. Got it? Now, really important, as long as the number's above 0, it has a positive expectancy. And the higher it is above 0, the better the system. Now, if you look at this diagram here, it shows you where you want to be aiming for as a trader. It's not 100% strike rate. It's not 10-to-1 reward to risk profiles. It's somewhere in the middle. And you can build this to suit you and your personality. Some people like being right more than they're wrong. Others don't mind being wrong more than they're right, as long as they've got a bigger reward to risk profile. But this table here shows you kind of what to expect in terms of the relationship between how often you're right and how much you win when you're right and how much you lose when you're wrong. So the question is, do you want to know how to build a profitable system? Well, you need to understand these things all together, right? So write these down. The first one, market condition. The second one, market phase. I'm going to explain all these in a minute. Number 3, support and resistance. Number 4, the use of indicators. Number 5, price action patterns. And number 6, candlestick patterns. Now, before I explain this in detail, because this is really important, I want you to know the most common mistakes traders make, which are ignoring the basics, right? So they ignore things like understanding the terminology, order placement, lot size, which I just alluded to on the spreadsheet there. And they skip the basics, which makes it really hard for them to succeed in the end. They ignore risk management, right? And they don't focus on preserving capital. Warren Buffett's rule, right? Step 1, don't lose money. Rule 2, see rule 1. If you can focus on not losing money, you make a lot of money as a byproduct of being a great risk manager. And the other mistake is being a slave to the chart. Over trading or under trading. So over trading is where you're taking too many trades that you shouldn't be in, and under trading is having a fear of taking trades that you should be in. So now you're out of trades that you should be in. Not many people talk about that. So if you want to be a professional trader over a rookie, there's some key differences on how a pro thinks in terms of their approach to trading compared to that of someone who blows their account over and over again. You want to write these down. So some examples are, a professional trader would say something like, did I execute my trades properly? Meaning, as per my trade plan. A rookie might say, I hope this trade wins. You know, that's the kind, maybe you've had these thoughts, right? I hope this trade wins. A pro would say something like, how do I survive long term? Whereas a rookie would be like, what's the fastest way I can profit? And that is instant gratification. It's not process oriented. It's outcome oriented. And then a pro would say something like, I only trade when conditions are right, as opposed to a rookie who needs action every single day. They thrive on it. That's how you lose money, right? So it's time to start changing your attitude towards trading if you want to make this work. Now, speaking of when conditions are right, imagine this, right? You've got a trading strategy and it's got a 60% strike rate, right? And you've got a reward to risk profile of just a 1-to-1. Now you take about 12 trades per month, like me. It's about 3 per week, okay? And out of that, with a 60% strike rate, you'll have about 8 wins and 4 losses. Now, if you're risking 1% on each trade, that means that you gain 8%, right? Minus the 4% losses, which means the ROI is 4%. Now, as I said, this is assuming that you're just trading a 1-to-1 reward to risk profile, which is the absolute worst case scenario. So let's say you're generating 4% per month, right? Now, initially, that doesn't sound like a lot, but compounded out over the year, that'll be 60%, a 60% return. Let me show you that just to prove the point before I get the doubt. Okay, so we've got our favorite compound interest calculator, right? I'm just going to put anything in here. Let's just say we've got an initial account balance of 5,000. And we're going to do 4% per month, right? And we're going to go for 5 years, just leave that on there. And we're going to see that that compounds out. The yearly compound is 60.1%. So 60.1% per annum. Now, let's just look at the compound interest calculator again. And let's just say that somehow you managed to fund your trading account with $50,000, right? Well, 50,000 in a little over 6 years, you'll be turning your account into 1 million, right? At which point you'll be churning out around 40K per month, 40,000 a month. So are you ready to learn how to do all of this? Because if you had the confidence that you could churn out 40 grand a month, I bet that you would have no problem generating a 50 grand account. So you want to learn? Take notes. Let's go. All right, we're going to start with the market condition, okay? Basically, you need to understand that the market moves three ways. It either goes up, or it goes down, or it goes sideways, right? Now, this is what we call a bullish market, and this is what we call a bearish market, and this is what we call consolidation, or sometimes choppy, indecisive market, where most of the pros just stay out because there's indecision and unpredictability, and traders don't really like randomness. So the first thing to identify is which direction we're moving in to form a bias. And you have to understand how to identify that we are in a true directional move instead of just a random move. So we have to identify a 3-point move, which is our initial high, our outside return or pullback, and then our new structure high. Okay, and this is referred to as a run. This is a pullback. This is a run. This is a pullback, and so on. Right, and the same on the way down. This will be a initial low. This will be a new structure low. This will be a pullback, right? So this is the run, this is the run, and so on. Okay, that leads us to the next point, which is market phase. Well, the market phase is where we're identifying where we're at right now. So are we in the run phase or are we in the pullback phase? And there's going to be different opportunities that await at these zones if we understand what phase we're in and what we're looking for in the bigger picture, right? So not one of these things that I'm explaining will give you a good trading system. It's all of them combined. When you can combine all of these principles, you start to build a lot of weight and a good case for your trading strategy to be highly profitable and something that you trade consistently because you've got subjective rules behind them. All right, so we've got the run phase and the pullback phase. So in a bullish trend, if we were looking to buy this market and jump on that trend as a trader, we would need to firstly identify the market condition, which, yes, it's bullish. And then we would need to identify the market phase. And what we'd be looking for is one of these pullbacks, right? We'd be looking for this move here so that we can buy the low. That's where we want to get in. We don't want to buy it on its way up, right? We want to optimize our risk reward profile and we want to get the best deal. All right, remember the next rule. The next rule is support and resistance. Right, support and resistance. So what you'll find is we now know our market condition, which is bullish in this instance, right? Long, up, right? We know the market phase. We're in the phase right here. Tick, this is the pullback phase. Okay. The next thing is looking at support and resistance. And what you find with support and resistance is in the market's previous, what we call resistance becomes support. And when the markets are moving harmonically in trend, you'll see that this happens frequently. Previous resistance becomes support. Now, if all of these things start to line up together, again, you've got confluence. You've got a confidence that you're building a really strong case for entry if all these stars align. So there's this horizontal support and resistance. Previous structure respects itself time and time again, but there's also angular support and resistance. And sometimes we can be in a position where the angular is present with the horizontal support and resistance as well. And that again gives more confluence and more confidence in our entry. The next one is use of indicators. Now I'm going to talk about two indicators here. The first is what we call an exponential moving average. Now, what an exponential moving average is it takes the range of movement over a set period of time to give you the average movement in price. Okay. And what I like to do is I like to use the 20, 50 and 200 moving averages. And if you put those on your chart as indicators and you see that they're all in alignment with each other and they start to fan out, it means they're all in agreement with each other that we're likely to continue with the prevailing trend. So again, I'm looking at the market condition, bullish. I'm looking at the phase, pullback, tick. I'm looking at support and resistance. We've got that, tick. I like to see at least 3 touches of support and resistance on a higher time frame. Then once we've got that, we can start to use indicators to give us extra confidence in the move. And if all of the moving averages that I like to use are in order and fanning out nicely, we know we've got confluence there. Some people also like to use something called an RSI, a relative strength index, or a MACD. And a relative strength index, you're looking if it's oversold, okay, which is conventionally at 30. I like to use 20, so it's an extreme filter. Or you might use a MACD, and what you're using those for is something called divergence and convergence. Now, divergence is where it doesn't match price, so you might see higher lows on price, but lower lows on the indicator, which means there could be a reversal soon. Or you'll see something called convergence, where it marries up with price. So you'll see higher lows on price and higher lows on the indicator. More on that in a bit. Okay, so 4 is indicators, right? Now 5 is price action patterns. Now this is where what we're doing is in that pullback phase, what we're looking for is a loss of momentum. So what you'll see is the candlesticks or the bars will start to get ever so smaller on the next prevailing bar. And what that indicates is a loss of momentum, running out of steam, right? And when the volatility starts to slow down and the market looks like it may reverse, that's when we can start to get really interested. That's where we start to see price action patterns. The price gives us the clue. Now, if you drop down to a lower time frame, you might even see that we get a retest, like a double bottom, as we call it, at that certain previous resistance becomes support level, and that will give you added confirmation that we can get in, and this is going to be a high probability setup. And then finally is candlestick patterns, right? And what candlestick patterns are, if you apply these with everything I've just shown you, and you apply all together, these are the candlesticks that I would recommend that you look at and go and practice looking at. One is called a low test candle, right? Which means that if this is the open, right, and this is the close, and this is the high, and this is the low of price in that session, then what's happened here is the bears have tried to push this all the way down and then been rejected by the bulls. Now imagine if we're at the end of our pullback phase and we see this candle here. What that says to us is we've tried to push down, we've been rejected. On the next candle, it's highly likely, with all of this confluence, right, all of these points, it's highly likely we're going to see an explosion to the upside. Okay, so a low test candle. Another one is a doji, which stands for indecision. It means indecision, and the open, the close, the high, low. The open and the close are usually the same price, where there's kind of like a tug of war going on here, and the bears and the bulls try to push each way, but we end up closing and settling where we opened, right? And that, using those candles with this confluence that I'm explaining to you right now, can be very, very powerful. And the other ones that I'd recommend looking at are what we call tweezer bottoms, where you get 2 candles where the body of the candle's in the upper 50%, and then you get like kind of matching symmetrical low wicks, what we call these wicks, right? And those are tweezer bottoms. Now, when you use all this in conjunction with each other, you've got a good system. And more importantly, you've got subjective rules. So using this together, you can build a powerful strategy, which is what I want to show you how to do. Now, the point of this video was to kind of catch your attention and see if you would watch this far. And if you're still here, I know that you're really into this, right? So let's take it further. I've got a 3-hour workshop coming up. You can probably tell I'm quite excited about this stuff. I geek out on this stuff. But I would love you to attend that 3-hour workshop. I'm going to be covering everything you need in detail so that you can walk away from that workshop excited that you have a plan. It's going to be a full 3-hour training, right? We're going to cover the fundamentals. We're going to go through live strategies. I'm going to share tools and techniques and real world examples. And most importantly, I'm going to give you a step-by-step plan for your success in your trading. So it's 3 hours of your time. You can block it out in your diary and we can get you to where you want to be without the noise out there. We are charging $7. And the reason we're charging $7 is just to get rid of all the trolls and the riffraff. You'd be surprised at how many plebs we get rid of just by charging a small amount of money. And I know you're not a pleb, right? We want people like you who actually want to learn. All right, and you probably caught that I haven't even introduced myself, right? My name is Jason Graystone. I've been investing in the financial market since I was 22 years old. I became financially free by the time I was 29, and I've helped hundreds of people become financially free, as well as help create over 30 liquid millionaires just in the last few years. I've built a huge reputation for being the most transparent and honest with my training, and I'm hoping that you've already gathered that just by watching this. So imagine that you're at a crossroads. You can either keep searching YouTube or books or social media gurus and stay in the land of confusion, or you can choose clarity and growth, and you can actually make this a reality, so you can actually live your dream life in the not so distant future. Sound good? Well, do yourself a favor, book onto the upcoming workshop now, because I'm excited for you, and I'll see you there.